Good morning, folks. We are going to get started here. Let me adjust my mic. That should be good. We are in store for a super mega intense training today, so make sure you have a strong cup of Java, your pencil, your paper. Okay, today's presentation is going to cover a lot of stuff. The main objectives of our group trainings are to help you take the mystery out of stock price movement. We want to help you simplify your swing trading methodology so that you can save time and kind of stick to rules. And we want to teach you the best use of the new Stock Pivot Trade Analyzer software. The 3.2 version has lots of new features and lots of new info. So I'll be reviewing that today. Now in the email that you received, basically the outline for today was I'm going to cover the 6 types of swing trading setups that the software generates. I'm going to talk about incorporating macro ranges into your trade analysis. I'm going to give you a secret little tip on how to know when to move your stop to break even on a swing trade so that you don't take a loss. And we'll just cover lots of good general topics about the trading process that a lot of people don't take into consideration when they, put their money in the market and risk their capital. A lot of traders approach the market kind of like a game. They want to trade, but they don't really have an idea of kind of the big picture and all of the possible scenarios that can take place. So we're going to be covering lots of cool concepts, and that'll be towards the end. So what I'm going to do is I want to kind of do a basic overview of some stuff so that we're all on track. I'm going to dive into the meat and potatoes and get into all of the really good detailed information that you're waiting for, and then at the tail end I'm going to go back and review some of the big concepts. These seminars where you start off and you have to wait an hour before you get to the good stuff. I don't want everybody's eyes drooping quickly, so I'm going to very quickly get into the good stuff, and then at the end we're also going to we'll get into like the general theories and concepts and all that kind of stuff. All right, one of the big problems we have in any kind of trading is analysis paralysis. What tends to happen with traders that spend lots of time trying to study the market is they buy the latest book, they try different kinds of indicators and software, they study all kinds of YouTube videos, and after a while, after a few years, they got a great trading library, then they got all the indicators, right? And they've tried everything, but they've never made any money. That's kind of the dilemma that lots of traders face. They're constantly jumping ship and trying something new. One of the issues is this. Any trading strategy, any trading technique or setup is not necessarily going to work the first time or even the second time. So if you go in and you try something new and you get burned, then you're likely to just give up on it and then say to yourself, oh, this doesn't work, and you move on to something new. And that's a big problem because you might have had gold in your hands right there and you just passed it by and moved on, right? So that kind of underscores the importance of testing and paper trading. If you come across something brand new and it looks good, you should not dive in Monday morning with your full account size and cross your fingers. You really want to watch it for a few months, evaluate it, track your results in a spreadsheet, and you'll be able to tell within maybe 2 months whether that particular strategy is viable or not, right? The other thing is any new strategy most likely requires somewhat of a learning curve. So again, you don't want to jump in Monday morning and bet the farm because maybe you don't understand it completely. All right, I'm a big stickler on get through the learning curve on kind of a sim mode or paper trading mode, understand the concepts, prove to yourselves that it can work by tracking the results in a spreadsheet and penciling out the results. Okay, you got to do that. So even somebody that buys my software and starts using it, you shouldn't jump in the first signal with all your capital. You really should evaluate it for a while, track your results, make sure you understand how it works, and if you do have questions, you need to get to me and ask me your question, and I'll give you the answer, because very small, subtle things can make a big difference in your trading, as I'm going to point out today. All right, moving forward. The Stock Pivot Trade Analyzer is a piece of software that really goes back about 12 years. Now, just about a year and a half ago, we kind of renamed the product and totally redeveloped it from almost the ground up. So you've got a really super duper state-of-the-art piece of software. But this piece of software originated over 12 years ago. I'll just tell you a really quick story so everybody here can understand where I come from. I ended up out in California, started a software company, started making a ton of money, and then I thought I want to get into the stock market because I want more money. Okay, I'm a greedy person. I like to make money. I had some beginner's luck my first year, and then I lost a boatload of money my second year. So I quickly realized that I wasn't as smart as I thought I was, and I really needed to go back and evaluate how the market worked. So after I lost all that money, I decided I would have like a one-year moratorium before I opened an account again, and I would start doing my own research. The good news is because I was a software engineer, I could write my own statistical analysis programs, and what I did is I ordered a disk from somewhere out of a Stocks and Commodities magazine for $39.95, and maybe in those days it was like a floppy disk, I can't remember even, but it had 5 years of all the stock data for the whole universe of stocks. I loaded that on my computer, and I started writing programs to analyze price movement. And within a few months, I had my first strategy, swing trading strategy, which involved the 5-day moving average. I think I was the original guy that championed the use of the 5-day moving average, because I don't remember really any strategies that were used with the 5 period. I actually don't remember anybody even really talking about it. Folks were into the 20-day, the 50-day, maybe the 13-day. You might have seen some strategies with like a 9 and a 13 crossover, stuff like that. I found that the 5-day was a really great moving average to use as a reference point for analysis. And so I championed that, and very quickly I developed a little piece of software that could grab the data off the internet for free and analyze the data using that 5-day moving average, and that was the birth of my very first product. It was actually called Stock Trade Pro. Then it became Stock Signal Pro. Got more sophisticated, became a bestseller on the internet. That software became a little bit obsolete over the last 5 years, and basically I stopped offering it over the internet. I had a lot of people, though, continuing to contact me, wanting to try to get their hands on it. So that's one of the reasons that I went back to the drawing board and developed this piece of software. Now, the cool thing about the Stock Pivot Trade Analyzer is I took what I had with Stock Signal Pro, which was basically just one swing trading setup, and I went on a research and development binge for about a year and developed a whole new set of swing trading setups. And the reason why is, although my swing trading setup in the original software was great, it only caught a certain type of move that stocks would make. Stocks made all kinds of moves that swing trade setups would not catch. Therefore, you might have a stock that ends up making a huge move, but there's no signal given, right? And so people would say, well, how come your software didn't catch that? Well, it was because it was designed to catch one type of a setup. So the new Stock Pivot Trade Analyzer has 6 setups, and they're designed, each of them is designed to catch a different type of setup that could occur before your stock makes the move. So what we're trying to do now is we're trying to cover all bases. All right? So if you are a current member of the Swing Trading Club and have your hands on the Stock Pivot Trade Analyzer, you've really got a sophisticated piece of software that really puts institutional strength analytics, into your hands, a very affordable price. And the issue now facing us is that I have to train everybody on how to interpret and use all that data, because you do get a boatload of information that gets generated. So that's what we're going to dive into today. All right, the software, let's just go over a couple of functions and features real quick. You got 5 separate watch lists, and the original version of the Pivot Trader, there was just one watch list, and then people were saying, well, how can I separate things into different lists? So in one of the early versions, I gave you 5 watch lists that you can sort and move things around. You get free stock data from the web. It runs powerful auto analysis, so you can put up to 800 symbols in the software. The reason I limit it is because, well, there's a couple of reasons I limit it, but one is that you really don't need to load it up with any more than that. This is not a scanner, although it kind of has scanning capabilities, but this is not a thing where you load 10,000 stocks in it and you scan through them. This is where you build watch lists of good trading candidates, and then you let the software do the analysis for you. The latest version, the 3.2, has been sped up by 10 times. I was able to figure out a couple things that increased the download and analysis speed greatly. So we had a major jump in the speed of the processing in this latest version. I think you can run 500 symbols now in like less than 10 minutes. You've got all kinds of filters and sorts to look at the results in different ways. And then there's some export functions built in. You can run stuff out to printed reports, export them to spreadsheets. You can export your list to the web so you can do research on FinViz. All right. The main job of the software is to save you a ton of time. So, I could sit here today and I could teach you all the details of each one of the setups, right? I mean, give you all the math, give you all the details, but for you to sit and calculate all that stuff on just one symbol, you'd take like a half hour, right? If you were going to do it all by hand. And then imagine trying to work through, 30 different stocks or 50 different stocks. And then imagine you've got 6 different setups, and you also have other information. So the real big benefit of the software is that you can load this sucker up with your, trading candidates, run the analysis each evening after market close, afternoon, and the software does all that number crunching for you and gives you the results and gives you trading ideas to work with further. Okay, very important concept to understand. When you get a signal out of the software, an alert out of the software, it doesn't mean you just blindly jump into that and it's guaranteed to work. It's not how the market works or can work. The job of the software is to do a massive amount of number crunching that you couldn't possibly do yourself by hand, give you those alerts as trading ideas, basically condense it down into a list of alerts, and then you've got a smaller list of stuff to look at and analyze to go forward. You're going to do your own due diligence, and you've got trading ideas. Okay, so great news. You could load this sucker up with a couple hundred symbols. You tag them all, you hit analyze, you go to the kitchen, make yourself a martini. Okay, come back, you've got everything ready. Now, let's just while we're kind of talking about the downloading and the analysis, let me just give everybody a quick tip here, because there's lots of little details in the software and people get confused, and this is something that a lot of times I get people ask me about this. And you know what, you can't really see it too good where the arrow is, but it says suppressing the current quote. So people are like, well, what the heck is that all about? What the software does is it grabs historical data off the internet for free for each symbol. Okay, that was one of the first things I figured out a long time ago when I was tinkering around, was I could actually just take a snapshot of historical data off the internet and pull it into my software. It was a beautiful thing. And the only issue is that the software, the data doesn't get updated till later in the evening. All right, sometimes 3 or 4 hours after market close, the historical data. However, there's also a current quote, which has, it's either a 5 or a 15-minute delay. So what the software does is it goes out, grabs the historical data, then it grabs the current quote, and it sandwiches the two together. That allows you to run the analysis shortly after market close. I typically tell people, you know, when the market closes, give it about 30 minutes, come back, you can run it, you'll have all the data. Okay? Now, the reason that we have to suppress the current quote, 2 reasons. One is, let's say this is the pivot trader is an end of day system. Okay? It utilizes end of day data to calculate, analyze, you know, come up with the trade alerts. And I just said it grabs the current quote, right, to try to sandwich it in there. If you run it during market hours, it's going to grab the current quote. And it recognizes, hey, this data is not in the history data, so I'm going to sandwich it in. So it's not going to be accurate. Okay. If you were not able to run the analysis the day before, okay, the evening before, and you wake up and you have to, you want to try to run the analysis during the day, you can suppress the current quote, and it's just going to grab the historical data, which would be what you want the previous day. Make sense? Now, I could try to have it figure out that it is during market hours, but then I deal with all the time zones, and if people are in other countries, it just turns into a huge hairball. And then you have to, you know, you have to tell the software what time zone you're in. And so it was just easier to build this little suppress button. Now the other thing is, once in a while, by the way, the data comes off of Yahoo, but once in a while there could be some issues with the current quote. We've had issues in the past. They sometimes spring up. They're localized. It'll be funny, maybe for a few days, there'll be a little issue on the East Coast, but it doesn't affect anybody else. Then there's an issue on the West Coast. And that's because the servers, the data servers are all distributed around the country for like backup and parallel and stuff like that. So if you should, and the problem is the data errors that come through are really wacky and really different, and I've tried my best to trap these errors, but if you should ever run your analysis and get an error screen that pops up, you know, it could be anything, but you'll have an option to ignore or cancel or continue or whatever. You could just hit cancel, come back, and you need to rerun it. Just suppress the current quote. And what you'll have to do is you'll have to wait a little bit longer. Here's the times down here. Okay, and that's the other benefit of this. And we had this issue maybe 6 months ago for a week or so, went away, not an issue now. All right, but it's double duty, it's built in there. So that's what the current quote is all about. People get all confused about that. All right, okay, let's talk about swing trading as a concept. Swing trades typically last anywhere from 2 to 10 days or longer. You could be in a swing trade for 15 days. when you do all your number crunching at the end of the series, maybe after a couple of months, you're going to find that probably between 4 and 5 days is your average length. Now, if you want to be what's called a position trader and hold your positions longer, that's great. The software still helps you with that. It's just a matter of not taking profits as quickly, right? Once you get into a trade and you protect it, you can let the thing work a little bit more. Okay, I'll get into that as we go along. We target 4 to 6% gains as kind of an initial target. Those are high frequency targets, and the secondary targets tend to be 8 to 15%. Now that's just on your typical average stock. We all know that there's a lot of these lower price stocks that can be 10 times that amount, right? You can get 20 and 30 and 40, 50% gains very quickly on these $2 and $3 and $4 stocks. So this is just kind of a ballpark. The software does give you average ranges of the stocks. It computes them, so you can kind of extrapolate on that. 7 out of 10 trades can be winners, and I'm going to get into why that's possible. So just keep that in mind. So what we're shooting for is a 70% accuracy rate. A lot of people will say, well, how is that possible? Well, I'm going to show you as we get down into the details how that's possible. We want to cut the losers quickly. Normally, you don't want to take more than about 2.5 to 3% on stop-outs, but again, that's going to be relative, because if you're dealing with a small priced or a lower price stock that's got huge ranges, you're going to have to set your stops based on that stock. Okay, so we'll get into that too. Position sizes are determined by the fixed dollar risk calculator and should be scaled out. Okay, I'll get into that as well. These are just some basics about swing trading. Now, swing trading, there's a lot of components to it we got to take into consideration. The first one is the stock selection. The second is the actual trade setup. That's what the software is so good at. The entry, how do you do the entry? Where's the initial stop loss put? How do where do you determine your exits and your trailing stops, that kind of thing. And then finally, position sizing. All right, and there's probably some other things too, but those are the basics that you've got to keep in mind in the process. Swing trading is a process, and as your trade develops, you've got to move on to the next phase and understand the implications. All right, we're just getting some of the basics out of the way here real quick before we get into the cool stuff. A basic tenet of the Stock Pivot Trade Analyzer is that it utilizes the 75 period SMA, 75-day simple moving average, as a basic determinant of the trend. There's a little bit more to it than that, because stocks are not always in an uptrend or a downtrend. Sometimes they're in kind of a choppy sideways trend. So there's some details that the software will use to determine if you're in a neutral trend. But so that you can have the same reference points on your charts, you'll want to plot a nice big fat yellow line on your charts, or whatever color you want, of a 75-day moving average. If you have a strongly trending stock, you're going to see it moving, you're going to see the price moving above an upward sloping 75. Vice versa, you got a stock in a downtrend, you're going to see the price moving below a downward sloping 75. So get this moving average on your daily price charts so that you have this as a reference point, and you'll be able to see pretty quickly what you're dealing with. Now let's talk briefly what makes a stock go up and down. Remember now, we've got the underlying trend, could be a strong uptrend or a strong downtrend, or just a neutral sideways trend. But within a trend, we've got cycles. Price surges forward and tends to pull back, or in the case of a downtrend, price drops and then tends to retrace. Okay? Now, one thing that you'll notice, and especially when you run like statistical analysis like I've done over the years, you tend to get 2 to 3 and 4 times the move to the upside as you do on the pullback. Okay? Big surge, small pullback. Big surge, trend continuation. So what causes that? Well, at any given time, remember, price is always determined by the emotions of the trading populace. Okay, there is actually no market as an entity. It's kind of a sum total of all of us nuts trying to bet on the prices. And so what we got here is when price might be lower, that might be an area of perceived value, and so the buyers are more eager down there, and there's a lack of sellers because the sellers, they're not ready to sell. They realize that, hey, the price could go higher. As the price climbs, the further the price goes, and this is the short-term cycle as well as the overall big cycle too, but short-term cycle, it runs up into a zone where the price appears overbought to the majority of folks. Maybe the technical analysts see like a resistance line at some point, or maybe the price has popped out of the top of a Bollinger Band, and you read in a book somewhere that that's overbought, and so the buyers tend to dry up, and the sellers are more eager. Okay, that's where if you're in a trade, you see the dollar gains, and so you maybe sell your position. Maybe you have a target that gets hit. You've got a limit order there, or maybe you have a trailing stop that you're following up. So at some point, the buyers dry up, so there's no more upward momentum, and things start to come down, start to hit stops, and the selling increases, and we come right back down again. Okay. That's the basic cause of the swing cycles. Okay, now remember, your typical swing cycle is roughly between 5 and 8 days. It could be shorter, it could be longer, but that's, if you average it out, it's typically around 5 to 8 days. So our basic concept in swing trading is this. We want to identify a trend. We want to, when the price surges, we want to realize, okay, there's going to be a point where it gets overbought. It's perceived as overbought. The buying will dry up. The sellers will come in, and we're going to come back down. We're going to pull back, so the price is going to drop. Remember I said that price tends to move 2 to 3 or even more times the distance in the direction of the trend as it does to pull back. So we want to be on high alert then to be able to jump into the trade here, to take advantage of the next cycle up. Okay? Now, one question you might ask yourself is, well, why wait for the pullback? Why not just jump in over here, right? Well, nothing's going on over here, you see. One of the things we want to do is we want to wait for some kind of action to develop. If the market could be trading sideways and just not doing anything. We could jump into a stock and it just won't do anything. Or we could jump into a stock and it actually, starts to sell off. So we lose money. So we want to wait for the price movement in our individual stock or in the market to wake up, give us some sort of a clue that it's wanting to trend. Okay? One of the analogies I use, when you watch these old movies about, the Romans, Roman warfare, and you got the one big army facing the other army on the battlefield. And I always ask people, well, if you were one of those soldiers, would you want to be in the front line that has to go charging across the field into the enemy? All right, you want to be in the front line, or would you rather be kind of the reinforcements in the back? If that first wave works, then you can come in behind, and obviously nobody would really want to be on the front line. So that's kind of the same concept here. We want to let the stock or the market give us some indication that it's got strength, and then we're going to get in at our first good opportunity at a good price that will give us a opportunity to get the price moving in our favor quickly. Okay, I'll come back to that concept. So let's talk about like the basic sequence of a swing trade. Swing trades have all kinds of phases that they go through, so we're gonna talk about them. When you look at your charts, you can start analyzing what's actually taking place. Now the software, like I said, does all the number crunching for you automatically. And so the great value of the software is the speed. You can get the analysis going and leave, go watch your favorite television program, come back, all the work's done, right? Plus, the software is going to do it correctly. It's not going to make any boo-boos. Sometimes one of the problems with doing your own technical analysis is that you might accidentally be biased about something, and you're not going to just stick to the strict numbers, right? Software doesn't do that. It's emotionless. So the first thing is the reference point with the 75-day. So here we got a stock that's cruising up above the 75. The 75 is sloping up. So we know we've got a stock that's in an uptrend. So the next phase is this. We see a pullback develop. Okay? Now, you're always going to see in the swing trading cycle, you're always going to see a pivot high. That's this little guy right there. Pivot high is, just a real quick review, it's one day that pops up above all the others, basically. You've got 3 or 4 lower highs before, and you've got 3 or 4 lower highs after. So it's like a little needle or a little antenna sticking up, right? So you're always going to spot that, and that's kind of the starting point of the swing cycle or the swing trading setup. Then we look for a pullback. Okay? Now each one of the 6 setups in the software follows kind of this basic formula, but there's lots of variations, which is why there's 6 different ones. But we're going to just cover kind of the basic concepts here. So we look for a pivot high on a strongly trending stock. We want to see several days of pullback. And now this one here would be what's called a deep pullback. And you see the price comes all the way down to the, above the 75. The software would detect that and do a bunch of analysis and then issue an alert. Deep pullback, it gives you a price to watch, gives you the price, you're going to have a stop and targets and all that. And, there's a lot of different factors. For instance, one would be, okay, we got the pivot. We've got X number of days of pullback. The pullback comes down to the 75. We have what's called a long range down close. Okay, you see that this bar here is a big old long range and the close is at the very bottom. Okay. At this point in the cycle, like either midway or a little bit further, that denotes selling exhaustion. Okay. One of the ways stocks get to go back up again is because all the sellers exhaust themselves and they dry up and they're not around anymore. So when we see a bar like this, and the software looks at stuff like this, we know that, hey, the swing cycle is in progress. We've got an exhaustion bar here, and then we bounced like right above the 75. Here we've got an inside day, okay, and then we got another inside day. So that's what's called a inside day times 2. Okay, it's a very high probability pattern. When we put it all together, we've got a high probability setup now that price will want to move in our favor, right? Now, let's talk about this price to watch, because this is another thing that people get tripped up on. The software uses this terminology, price to watch, long at 37. Notice it doesn't say buy at 37, okay? There's too many variables that go on in the whole process, which I'm going to get into. So the software can't tell you exactly where to buy the stock. All right? It's not a cop-out. It's not like I'm trying to, like, you know, save face or wiggle out of anything. It's just the way it is, and I'm going to show you why as we go forward. The price to watch is we can think of it in a couple different terminologies here, okay? So keep these in mind when you see this. We can also call that like a trade price barrier, okay? We can call it a trade trigger line. We could think of it as a line in the sand. We could think of it as a visual reference point for a potential trade. Okay, you see the difference? It's not saying you got to buy it here. It's saying that's where we want to watch for ongoing action. Because it's very possible the very next day the price is going to head lower. The software is going to give you a new price to watch. Okay? So the first thing you want to do, if you're interested in a particular stock and you get an alert and you're ready to get into a swing trade, you're going to want to put a horizontal line on your chart as a visual reference point. Okay? Here's what this looks like. So here's your line in the sand, right? Your price to watch, your trade trigger line. And we don't take a trade unless we can see the price of the stock try to penetrate that and breach. That stock could trade lower the next day, drop below the 75. We wouldn't want to take that trade because it never made it past the line in the sand. That make sense? Now, the question then is, well, when do you buy it? Do you buy it like right away? Do you wait for the close above it? There's all kinds of variation. A lot of it's going to depend on your situation. If you are one of these people that can sit in front of the computer all day and watch the action, then yeah, you could buy the stock as soon as you see it penetrate that line. If you're a busy professional on the road or at the office or in meetings or whatever, you're not able to watch the market, you can come back the next day and you see that you've got a close above, and so you can work with that as a potential entry point. So once the stock can breach that, then we want to also, when we get into a position, we want to put our stop in. Okay, these are basic concepts. Now I was saying that my original piece of software had one type of setup, and that setup was the deep pullback. All right, and although it was really great and pretty darn accurate, it was just one setup. Some stocks don't give you deep pullbacks. They only give you shallow pullbacks because they're too strong. So the original software, you really missed all of the super strong stocks. It could never catch an entry because those stocks never did a deep pullback. The other thing is, if you had stocks that sold off heavily, they went past the deep pullback and there was no entry. Now this version gives us a super deep pullback. All right, and I'm going to go over each one of these. There's three other types of entries, and those three entries have to do with ranges. A little bit different. They involve pullbacks, but they also involve ranges, so we'll get into that. Here they are. Let's just go through each one of them. So I showed you shallow pullback, deep pullback, super deep pullback. Here's some of the range type of setups: springboard breakout, convergence breakout, and the new macro line setup that is in the latest version 3.2. Okay, so again, you've got an institutional strength analytical program in your hands that's going to do massive amounts of calculations and automated technical analysis for you, but you got to understand how to trade off of it. Okay. All right, so let's talk about the shallow pullback. Shallow pullback is designed to catch the high flyers. These are stocks that are on a tear. They're moving so fast, they don't slow down for nobody. Okay? They don't do a deep pullback. They make massive moves to the upside. They might take a rest break for 2 or 3 days and not even pull back very much. They might just even trade sideways for a few days before they blast off again. So the shallow pullback is designed to catch those. Here's kind of a little bit about each one. Now, I can't get into all of the details about every part of the setup because, for instance, a shallow pullback has 3 variations that uses different calculations because stock behavior gets pretty complex and it has lots of variations, but the trade still ends up working and it's still a shallow pullback. All right, but here's some basics so that you can start to understand how the software looks at these setups. The first thing with a shallow pullback is we're running above the 24. That's how strong this stock is. The 24 SMA is above the 75. They're both sloping up, and the price is running hard above that 24. The software detects a 5 to 8 day run-up above the 24, off the 24, and then looks for this pivot. Now, it's going to use what I call a 4-1 pivot, which means it gets 4 days before, but as soon as it gets 1 day lower with a higher low, that's the pivot. Okay, that's what's called a potential pivot. If we wait around too long, we can miss the action because we're sitting there waiting for 4 more days. Shallow pullbacks sometimes don't last that long. They last just a few days. So what we're doing is we've got a high level of anticipation going on. All right, so 4 lower highs before and 1 after, and that meets this criteria. Put up pivot high in place. We end up with a 2 to 3 day pullback towards the 24. Okay, so here's our couple days, and that's going to generate a shallow pullback. You're going to get an entry here. Shallow pullbacks can give you ginormous moves. They're really a beautiful thing, and this is one of the first setups that I went back to the drawing board and said, okay, my deep pullback is missing these super strong stocks that are running like a bat out of hell. How do I develop a setup for that? So that's what the shallow pullback is all about. The next setup is the deep pullback. Deep pullback, you've still got a stock that's in an uptrend or a downtrend, but the cycles are bigger, much bigger waves, and there may be a little bit slower waves. They still work. I mean, you can catch an entry and then that stock can blast off. And so a deep pullback tends to move off the 75 and then pull back towards the 75 before it takes off. Now remember, a stock can shift the strength of the trend. So for instance, you could be in a uptrend where you're getting deep pullbacks, right? And then the stock goes into super high momentum and you shift into a you get above the 24 and you start getting shallow pullbacks. So you're going to see the software will automatically adapt and recognize that, hey, we're not going to do deep pullbacks anymore. We're going to do shallow pullbacks. So here's your typical deep pullback. The pivot high tends to be above the 24, but the pullback tends to go below the 24 down to the 75. Okay? Now again, there's a lot more to this. The deep pullback has like 5 variations. Okay? Because again, there's a lot of wacky ways that stocks can behave. And if you program something to just pick one, it might miss a whole bunch of other good setups. So you've really got to develop stuff to try to catch everything that's possible. So the deep pullback has like 5 different variations, but you don't need to worry about that because it's a deep pullback. It's basically a longer 5 to 8 day pullback towards the 75 period. All right, so the super deep pullback, what's that? Well, over the years, and when I do like the weekly show with investing systems, there's always people that want to ask about a particular stock. They wonder if it's a buy, right? And it seems like half the time people are looking at stocks that are in a major sell down, but they want to buy that stock. They want to trade it. And so normally, in the old days, I would just say, look, that stock's, it's below the 75, just ignore it. You don't want to trade it, right? Kind of hardcore, stick with the trend. But I went back to the drawing board and I did some research, and I was able to develop a swing trading setup that actually does work off of a big sell down. And I'm going to go into that a little bit here. And so that's called the super deep pullback. And how that works is this. You're typically going to get a super deep pullback when you have a stock that's been in an uptrend. So this is the 75 period here, okay? And the very first time it breaks down, it takes you'll get a stock that takes a major winger. It's going to give you a swing trading setup, a super deep pullback, and then you have a high probability it's going to try to retrace back to the 75. Now, once it gets back to the 75, all bets are off. We don't know if it's going to continue to the downside or it's going to try to recover and get back up above it. We don't care because the move is just this move back to the 75. Okay? So let's take a look at a couple examples of a super deep pullback. This is one that I actually traded, this exact chart you're going to see here. This is maybe 2 years ago. I believe that was the Australian dollar. Yeah, I think so. I did some research and I came across there was some fundamental information that caused this setup. China's economy had slumped by 30% or whatever, and Australia is their number one import trading partner, and so the Australian dollar basically took a major dump because of that, and this was one of the ETFs for the Australian dollar. So got a major breakdown. Here's the 75, right? It had been trading above the 75. Here's the breakdown and then the major winger, right? Everything red, just sell, sell, sell. Software gave a super deep pullback price to watch down here at 31.65. Okay. Yeah, so that's like February of last year, 2014. And so what we're looking for is we're looking for an entry, and we're looking for a retrace back towards the 75. Okay, and one of the targets that I use is I use a 3/4 retrace back to the from the breakdown point. Okay, so basically it measured from here down to here and 3/4 back up the way, and that was the target. Okay, that's just one little technique that I use, and that's like a first target. The price can go all the way back and touch the 75, or it actually can get to the 75 and recover, right, and go on. But our trade is here. Now this can be a pretty ginormous move. Here's a 10% move back to the 75. So these are definitely, tradable and can be profitable. All right, here's a here is a super deep pullback in the SDS, which is actually the reverse ETF of the market. So this trade here was actually a short play on the market. Okay, SDS is 2 times reverse leverage on the SPY. So in your mind's eye, flip this chart upside down. That was the market going up and getting ready to come back down, right? And so here was the SDS setting up as a deep pullback, and there's the trigger, 35.52, and you can see it filled and went all the way back to the 75, and that was like a 5% move on that. So one thing as a swing trader that you want to get into your head going forward is you don't always have to be biased to the long side on the market. Even if the market crashes, you're going to have trading opportunities if you just flip over and use some of these reverse ETFs. So that allows you to make money, you know, to the long side as well as to the short side. In the old days, you had to either short stocks or buy puts, which you can still do, but the reverse ETFs make it easy for somebody, let's say, with their you know, retirement accounts where maybe you're not allowed to short, or you don't have an option account, you can get in and play the market short using these reverse ETFs. So keep that in mind, that that's just another way to profit from the market. And the other thing is, if you know there's doom and gloom in the market and it starts trading lower, you don't have to think the sky is falling. You want to look at it, you want to look at everything reverse and think of it as a, you know, profit opportunity. Okay, it says one of the things you just got to get into your mind is you don't always want to be biased to the long side. Okay, let's get into the actual mechanics of the entries now, so that we can talk about the, you know, the process from the point of taking entry. Now remember, I said that price to watch, we want to think of it as kind of a trade entry trigger line, a line in the sand. That's your price barrier. That's your visual reference point. When you get a price to watch alert in the software, you want to plot a horizontal line on your chart. At that point in time, you probably don't want to take a trade unless the stock shows enough strength to be able to break that line. Okay? What we want to do is we want the price to confirm with us that it's ready to start the upcycle. The big issue with traders is they like to guesstimate. You know, oh, this looks like a good price. I think I'll jump in with, you know, 90% of my account. It's a gut feel reaction, or maybe they heard somebody on TV say, oh yeah, you know, this stock would be a good value at this price. Well, that's a losing game. It's not going to work for you. You can keep those prices in mind as a reference point, maybe put a line in your chart, so that you know when the price gets there that maybe, hey, that's a good area, but you don't want to just buy at a specific price like that. Okay? Now, here's how this works. We wait for the price to penetrate our line in the sand. If we take the trade, then we place the stop. Okay? The majority of the time, you're going to see stops around 3% or less, or a little bit more, but the software does those computations for you. It's going to look at the average range of that particular stock, and it's going to look at the recent behavior of the stock, and it's going to determine where your highest probability stop is. So you really don't have to worry about those mechanics too much. Just follow what the software says. Now, there's a couple things we can do once we take an entry. Let's just briefly talk about the issues with trading. Once we take an entry, remember, one thing I'm going to get across is that there is no such thing as, you know, perfection in technical analysis. The market is a pretty sloppy place. I always joke and say it's like playing, you know, rugby in the mud. It really is. The technical analysis helps get us, you know, give us the edge and get us to the, you know, the most accurate point we can get, but there's still going to be some sloppiness and fudge factors in price behavior. It's just the way it is. There is no such thing as a perfect entry. There is no such thing as a supercomputer that gets it right every time. There is no guru that gets it right every time. And it'll never happen, because the issue has to do with you know, a little bit of randomness that is in the market. We can get really close and eliminate a lot of the randomness, but there's always going to be a little bit of randomness. Now, once you take an entry, how that trade turns out is going to depend a lot on how you manage the trade going forward. I get folks that come in and say, hey, I took some trades off your software and they didn't work, right? Why didn't they work? Well, first of all, not every trade's going to work. But the second thing is it has to do with how you manage it. Now, I'm going to cover a couple ways how we can get in there and reduce our risk, and we can help the management part so that we don't take a loss, okay? The first thing is we got to use a stop loss. You folks out there that don't want to use a stop loss or trying to use a mental stop, you need to stop doing that. That's just sheer insanity. The problem with not using a stop loss is this. Once you let the cat out of the bag on a trade and you let a trade go against you, you open yourself up to catastrophic loss in your account. And what does that mean? That means that you could be a really good trader, very accurate, make money, 7 out of 10 is a winner, that type of thing. One trade that you let get away from you could wipe out all of your gains for months, okay, and tie up a bunch of capital and cause a bunch of problems in your account. I know I've done it, and I've seen people that have done it. Here's your typical scenario. You don't use a stop, you let a trade get away from you, and what could have been maybe a couple $100 stop out turns into, $6,000 loss, and your money is tied up a year later. Why? Because you're waiting for it to go back to where you bought it. All right? And guess what? It can only get worse. Many times the stock will never go back to where you bought it. During the dot-com era, there were folks that took positions in stocks that were hundreds of dollars a share, and 10 years later they're still sitting on those, and their value is $3, $5, never going to go back to where they bought them. Okay, catastrophic loss. Trading careers ended. So we got to use stop losses. It's just the way it works. The other thing is you got to take into consideration some scenarios that could take place, right? You could lose internet for a couple days, right? What if there's a big storm or hurricane where you live? There's no internet. You can't get in to manage your trade. But if you had a stop loss and the trade went against you, you would have been knocked out. You could be cleaning the closet out and a bowling ball could roll off, hit you in the head. You go into a coma for 6 months, right? Your wife doesn't know you're in the trade, right? You wake up and you've got a $10,000 loss. So I've heard all the objections against stop losses, but it's just really part of the trading process. Got to use them. If you don't, you're playing Russian roulette. You're eventually going to get burned. It's just the way it is. Now, so how can we deal with the stop loss situation? Stop losses, the way you want to think of a stop loss is a necessary evil. They're not perfect. In fact, they can be frustrating because they can get hit, and we can get knocked out with a loss, and then the stock can turn around and work, right? The trade could work. That is possible. That's just that's just the name of the game. When a store is in business and they have hundreds of customers, there's going to be people that, do chargebacks, right? That's just part of the process of doing business. Same thing with trading. We're going to have stops hit that could protect us, or we're going to have stops hit that could turn around and work. Okay, so the software, the first thing we got to do with stop losses is we have to figure out where's the best place to put the original stop loss, okay? That's what my software does. It utilizes a whole bunch of cool stuff that I've developed to try to figure out where is the perfect place that's not too close but not too far, okay? Our dilemma is, obviously, if the stop loss is too close, we can get knocked out by a little wiggle. And if it's too far away, hey, that might protect a lot of trades and give trades lots of wiggle room, and they may work, but eventually one of those big old stop losses is going to get hit and ends up being the same as lots of little stop losses get hit, right? So our initial stop loss is real important. here's the thing. Most traders approach the market as a, a coin flip type of thing, or win or lose, right? You're either going to win or you're going to lose. Doesn't have to be that way. We can manipulate the trade in the trade management phase so that we prevent a stop out, and we prevent losing, and that becomes a break-even trade or a wash, right, or a draw. So we don't always have just wins or losses. We can have win, loss, or draw. And that's one of the things that helps us keep our percentages high, 70% wins, right, 30% losses. How could we do that? Because a bunch of the potential losses might have been, we might have been knocked out at a break-even level, okay? And so that reduces the number of losses. Now, one trick is what I call the delta neutral stop move. I stole that phrase from hedge fund terminology. They used that term, I think, way back in the 70s, even early 80s. Delta neutral portfolio management, where everything was kind of balanced. So I kind of borrowed that, and I call it the delta neutral stop move. And basically what it entails is we find a very high probability first target that's almost sure to get hit, and what we do is we sell half at that point. As soon as we hit that target, we get our stop loss up to equal the distance, okay? You'll see it here in the next slide. And that way, now we can't lose. The only way we could lose is if there was a overnight gap down against us, right? The company has bad news or earnings, bad earnings. You don't really want to take a trade right before earnings, but there could be reasons. There could be a gap down. Now, gap downs do happen, and they are annoying, but if you're trading correctly and you're doing a lot of trading, and you're not going to probably see too many occur very often for you. I mean, yeah, they can happen, but they're pretty rare. Remember, the gap down has to occur like right after you buy the stock. So the odds are that they don't happen very much. I might have 2 gaps against me per year, and they're not very big, right? So that's just another little thing we got to keep in mind. But the delta neutral stop move, and the way the software is designed, it determines a very high probability target that also has to do with where we can move our stop to still give the stock plenty of wiggle room to work in the trade. All right, so here's our pullback. Here's our line in the sand. Here's our trigger. You buy 200 shares. Because it's a precision entry, we run up, we hit the first target, we sell 100 shares, we have 100 left, we move our stop up to equal distance. Now we can't lose. Make sense? We've made some money, and now we've protected the other half, and we can let the thing work and sleep at night and not fret about the trade. Let's talk a little bit about the targets. You're going to get 2 targets in the trade alerts. And basically, in general, here's how things are calculated. Okay, I mean, there's a little bit more to it than this, but this gives you enough to understand what's happening. When you get an entry, the initial protective stop is going to be somewhere around 2 times the average volatility of the stock. And the software, what it does is it computes the volatility based on like a 10-day period, but it also does a couple other things, like it knocks out some of the extremes. So we don't want some weird anomaly, I got to pronounce that word correctly, or bad data to affect the calculations. So basically, I'll grab a bunch of data, I knock out the extremes, the extreme low, small ranges, extreme big ranges, and then I work with the creamy middle, and that gives us a truer idea of what the average volatility is. So we're dealing with about 2 times the average volatility on the stop. Our first target is going to be about 1.5 times the average volatility to the upside. Our second target will be 4 times the average volatility. Okay. Now these are just suggested targets. You do not have to take the targets. And I'm going to talk, as we go forward, I'm going to talk about a couple different ways to swing trade. Okay. You don't have to do it. You don't have to do the delta neutral. That's just one little technique that you can use. And you don't have to set your regimen in stone either. You can be very adaptive to market conditions. For instance, if we're trading in kind of a choppy market environment and the swing trades don't seem to be following through, then you definitely want to do the delta neutral so that you can, protect your positions. When the market starts to heat up and things start to follow through and work better, you can adopt another strategy, which I'll go into in a little bit here. Then we've also got parabolic targets that the software generates, which I'll talk about a little bit. But that's kind of a basic idea. Okay, let's continue to burn through these quickly because there's a lot to go through. Why are precision entries so important? I mean, why make such a big deal about these super precise entries, right? Why can't we just find a stock that looks like it's going in the right direction, and why can't we just jump in? Well, we could, but one of the big issues is this. It goes back to what I was just talking about with like not using a stop loss. If we buy a stock at just, let's say, a random price, let's say the stock is in an uptrend, it looks good, we're just going to jump in, right? Well, as soon as we buy a stock, it's either going to start moving in our favor or moving against us, right? We take a loss. If we don't have a stop loss, we're put in danger of catastrophic loss. So, therefore, you do have to use a stop loss, right? But if your entry sucks, you've just increased the likelihood your stop's going to get hit, okay? Because you just have a random entry. We want precision entries so that we can have a high probability to at least get an initial move towards a first target. Okay, that's the goal. Just if we can get towards a first target, we can protect our position and we're off to the races. Now, here's an issue that we have. And I want to make this very clear to everybody so that everybody understands this concept. The software is a state-of-the-art, institutional strength analytical program, but it's not perfect, and it can't be perfect, and nothing can be perfect. Merrill Lynch, or the big brokerage companies that have multi-million-dollar systems, they can't be perfect either, because at the point of entry, we have what I call the gray zone of randomness, okay? Meaning that right when you take your entry, it's kind of like quantum mechanics, if you know anything about that. I don't know much, but I know enough to know that there's uncertainty. Things can just go any which way at that point. The reason why is because price is determined by the populace of traders involved, right? It's determined by their emotions, their fear, and their greed, right? We all know that. So one thing that can happen right after our entry is that a news event can come in and change that emotional sentiment for the players that are involved. Okay? So we can have the best technical setup in the world, and the rug can be pulled out from under it because of the emotional shift of the participants. Right? So you have to understand that as part of the process of trading, whether it's swing trading, day trading, investing. It's just the way the market works. It's a little bit like gambling, right? We can have the most state-of-the-art analysis, research on exactly where the best setup is, take the entry, and once we're in, we end up with the problem. Okay, so back to this concept of the gray zone of randomness at the point of entry. So our job as a swing trader is to do the technical analysis that's going to get us to the most exact high probability point of entry that's possible, but then to realize that once we pull the trigger, we've got a zone of uncertainty that the trade could go either way. Okay? And a good way to think about it is this. Here's a great analogy. It's kind of like a stampede of buffalo. All right? You've heard the phrase that the market is kind of like a market participants are kind of like a stampede. So what can happen here is this. Imagine in your mind's eye you've got a herd of buffalo. They begin a huge stampede in a certain direction. All right? And there's some buffalo up front, right? And they're running like the dickens, and everybody, or all the buffalo behind are following the guys in front. Now suddenly a fox jumps out of a hole, scares the guys in front, and they quickly shift direction. Everybody follows that direction. Okay? And so you get this huge herd mentality, and they suddenly shift direction because of that little event. That's exactly the way the market can work, exactly the way stocks can work. You can have a stock that's set up perfectly, that's starting to move in a certain direction, and then a small event, it could be a news event, totally shifts the direction of the price, and the stampede goes in the other direction. So keep this in mind. The most perfect trade setup, whether it's from me or from some guru or from a supercomputer from Wall Street, the most perfect setup can have the rug pulled out from under it after you take the trade. Okay? So again, that's another reason that we got to use stops in this business. So one thing you want to keep in mind is this. The trader's biggest challenge after the original analysis, right, and maybe after the learning curve that you have to go through to understand how to trade, is always volatility at the point of entry. I equate it to like an airliner taking off. Sometimes you get a flight, nice little takeoff, you cruise up to cruising altitude, no biggie, right? Other times you might be taking off in inclement weather and you got extreme turbulence right at takeoff before you can get up to cruising altitude and get above the clouds. Great way to think about trading. You get into a trade, it can either take off really smooth or you might have a ton of turbulence right at the point of entry. This remains our biggest challenge in trading. I remember reading this in a book 15 years ago, and I couldn't understand what the author was, what he meant by it. Volatility at point of entry. Why is that a big deal? I mean, if you've got a good setup, it's going to work. Just get in and stay in, right? Well, we've got the issue of you have to use the stop. The stop's got to be a certain distance, and that's where the volatility comes in. And now after all these years of trading, I know very well that he was exactly right. This is one of our biggest challenges, volatility at the point of entry. So what we want to do is we want to do things that can help us protect our capital if we end up experiencing volatility around the point of entry. Okay? Now, one thing we can do is we can figure out a way to kind of temper our swing trading setups. The market goes through phases, and stocks go through phases. They go through phases where things go very smoothly, okay, like that nice smooth takeoff, and then they go through phases where you have a lot of turbulence. All right, so one thing we can do is what's called the 3-day rule. Now, on my online learning center for the Swing Trading Club, I've got a video on this. It's just a nice little short and sweet video. I think it's like 5 minutes long. Goes through this. If you haven't seen it, you'll want to go watch it. And I'm going to just show you the basics here. Let's say that we have a swing trading setup. It could be any setup. It could be from my software. It could be from your, something you use. It could be a recommendation from some stock picker on TV. There's your line in the sand. There's your buy point. All right, so what we do is we get the trigger move, right? This price moves up through the entry point, and then we get our stop in. Okay, setup could be perfect. We got our trigger, we're in the trade. Now, because of volatility at the point of entry, we get this little wiggle back against us, knocks us out for a loss, right? This all happened to us. And then the darn trade goes on to actually work. This right here is probably the number one reason or excuse that traders use to not use stop losses. So here's a little technique that we can use to put a filter on our trades. You don't have to use it every time. It kind of doesn't make sense with the shallow pullbacks, because the shallow pullbacks are like spring-loaded, high-octane stocks, and if you wait around too long, they can bolt. But a deep pullback, a super deep pullback, if you're trying to get into a stock that has sold off really heavily and you're trying to find a bottom, this is a technique that can help you. And here's what it is. What we do is we use what's called the 3-day rule. The 3-day rule is once we have our line in the sand where we want to try to take a trade, what we do is we just go back 3 days back. Okay, so we got three days on the chart, and we just go back to the 3rd day, and we're going to use that high. That is kind of our line in the sand. As each day progresses, we shift that. Okay, so here we got a new 3-day. Now this is where we originally would have got in, but we're going to count back 3 days, and there's our high of the 3-day range. And now we get another day, and so look what happens. So see how we shift, and now we're above the current 3 days. So every new day that comes in, you're just going to draw a line above the highest of the 3 days. Now notice how it kept you out of the trade prematurely. You got that little blip down, that little bit of volatility at the point of entry, but then you eventually did come up and you did trigger above the range of the current 3 days, right? And then you can see how you got into the trade. Now, in your software, and this is just a good basic technique you can utilize, but in the software, I've got a little bit higher tech version of this, which is the micro range. I'll load the software up and show you where that is. That does this exact thing, but in a little different fashion and a little bit more accurate. Okay, so that's built into the software now. On every stock, every day when you run your analysis, you're going to have that line. Now, in the email that went out, there was one of the topics we were going to cover was a little trick to know when to move your stop to break even. Okay, this is a Swing Trading Club stock pivot trade analyzer exclusive. This is the first time I've ever gave this little trick out today, so top secret. Here's what it is. I told you how the 5-day moving average was one of the first moving averages that I started working with like over a decade, and it's really a great little utility moving average. You know, if you plot a 5-day SMA on your charts, it really can help you just instantly look at a stock and know whether the stock's trading lower, trading higher. Typically, if a stock's in a down cycle in the swing trade, it's going to be below the 5-day. And when it starts the up cycle, it's going to cross that and move above it, right? Here's your little trick to know when to get to break even. Break even is defined as like your entry point. So let's say on a hypothetical trade, here's your line in the sand, right? That's your trigger line, price to beat. So here's your trigger day. Price actually moves up, and you would have taken the trade here, right up under number 1. Okay, you're in. Now, break even means that you put your stop at the same spot. So if you had moved a stop to break even your first day, well, the very next day you would have got knocked out, right? And so that's part of the dilemma. When do we know when to move the stop to break even? Here's a real simple trick. And again, this you will always want to plot your price to watch or your trigger lines or line in the sand. You always want to plot a horizontal line on your chart. Once you get into a trade, when you see the 5-day moving average cross above your trigger line, that's when you move your stop to above your entry point. 9 times out of 10, you're going to see you're not going to get hit then. The trade can take off and work for you. Okay, this is just a little trick. The software in the trade management screen, I've got a couple different kinds of trailing stops that are automatically computed, and one of them utilizes a little bit of this technology. But this is just something you can do on your own. Even though you've got this sophisticated tool that you're using, you still want to understand a lot of this stuff and be able to understand what's happening on the charts. Think of the software as a really super enhanced calculator. You know, if you're an accountant or a tax person, you've got a calculator sitting on your desk, right? And it's helping you do your job. That's what the software does. But you still need to know how to do accounting. You still need to understand taxes, right? You just have a tool on your desk. That's what the pivot trader is. All right, so this is your top secret exclusive today. Again, wherever your line in the sand is, where you take the entry, when the 5-day moving average crosses over that line, that's when you move your stop to break even. Okay, that's a great little trick. No applause, just send me money. Send cash. Okay, let's keep going here. We got more stuff. We're just in the first wave here. We got a lot more to cover. Now, in this training today, I want to spend some time and talk about incorporating macro ranges into your trading. So far, we've been talking about like the nitty-gritty micro setups of the swing trades, and how can you do like a 3-day range and stuff like that to put a filter. Now let's talk about the macro ranges. This is a new type of technology in the software in the latest version, 3.2. I spent almost a year developing this formula to come up with this. I'm not going to get into the mechanics of it because it's a little bit complicated, but a lot of you folks have heard about what's called market profile. Market profile has to do with analyzing volume zones and volume levels, and one of the issues with market profile is it's like religion. There's like 3 different versions of it, and each group fights over who's more right than the other, and also it can be very complicated to learn and try to utilize. So what I've done is I've dumbed it way down, and you basically just get a line now. You don't have to worry about all the heavy-duty market profile concepts. What I did is I took the mechanics of market profile, I did my own research on it, and I came up with a way to figure out where macro breakouts could occur, or breakdowns. And the reason this is important is because stocks can get stuck in like large ranges, right? And they're not going to be able to start trending until they can break those levels. And that was kind of one of the missing pieces of the puzzle. What that means is that you might get some nice little swing trade setups while you're in a big range. They might work out fine, but you're probably not going to see any of these ginormous run-ups, the big trending moves, until you can break the range. Well, in the 3.2 version now, this one little line that gets generated every day is worth its weight in gold. I'm going to show you why. Macro breakouts. What happens is you have stocks that clang around in big cycles. And, if you zoom into here, you'd see lots of little cycles, and, you're going to get little swing trading setups here and there, and that could have been a deep pullback here. You name it. There could be, little convergence breakouts, and that's all great. You can get in there and try to trade that. However, the big run-ups tend to occur when the price can get outside of these big market profile ranges. Now, my little formula is a kind of a modified Jeffrey Brewer version of it, so there's some secret proprietary stuff in there, but the cool thing is it's another reference point for you to work with. So when you get a macro line generated in the software on a stock, you want to put a big old fat line. If your stock's underneath, you probably put a big old fat red line on your chart at that price. And that's your reference point. You may decide, hey, I'm not even going to try to trade my stock until it can get above the macro line. And there's nothing wrong with that. You might be able to increase your win rate as well as your overall profitability by only trading stocks that are breaking out of the macro breakout zones. So here's an example. Once you get a clean breakout, that's where we see the big massive runs. So this is a whole new level of analysis that we can kind of utilize on top of like the 6 little micro swing trade setups. So let's take a look at some examples. Okay, so here was a macro breakout. I don't know how clearly you can see it. Let me zoom in a little bit, and then that'll help. Okay, so back on August 13th of 2014, right here, a macro breakout level. I'm going to zoom back. A macro breakout level was detected. All right, so you see I got a line. It's not a fat line, but there's a line there. And that was the big macro overhead resistance area. All right, you can kind of see it. 26. You got that detected like 3 weeks before the breakout. So there's plenty of time to plot that on your chart and keep that as a reference point. Now notice what happened then is once the stock got above that, so it was detected here, and then the stock clanged around underneath of it for like 3 weeks. Finally broke out, pulled back. You got a deep pullback alert here from the software, and then there's your first move. There's your first swing trade. If you hung on to something, as of the date I made this chart, you had like a 57% gain on the stock. So you can see that once the stock got out of that macro range, that's where it took off like a bat out of hell. Okay, next example. So here's basically what you want to do. This is an example of another stock. The macro breakout level is being detected above at $11. So you go to your chart, you put a line at $11. Notice it really doesn't have to do with anything. It doesn't have to do anything with like your highest highs or lowest lows or anything like that. It has to do with volume profiles and things like that. And there's some other stuff under the cover. So you may see the price near it, or you may not see the price near it, but it's going to be generated at some point, and you want to just put a line on your chart. That's your reference point. Now again, you could swing trade in here. There might be a little shallow pullback here, another shallow pullback, but the big move occurs after the breakout. Okay, here's where it was generated. Stock clanged around, clanged around, clanged around, clanged around, finally broke out. Deep pullback, and then a whole bunch of shallow pullbacks the software would have generated to try to get you in, but look at the massive run-up then. Okay? This was another thing that we were kind of missing, and I was kind of missing, was I had fine-tuned the actual entries for the swing trading setups, but how could I kind of predetermine where a stock was likely to really bust out and make a move? And so I think I cracked that in the software. Let's see. Here's an example to the downside. Okay. Right here on this date here, a macro breakdown level was detected at 66.75. Now, it basically clanged around that level for quite a bit. So this isn't one of those things where you want to jump into a trade like as soon as you touch that price. This is more of a macro zone. Notice though, you broke down and then the software gave a shallow pullback to short here. And then look at the nice little plunge. 44% move at the point in time I made this chart. Now, you could either use this to short, or if you're a long-term holder of a stock, let's say you've been investing or doing position trades, and you've got some nice gains under your belt, and you get a macro breakdown level, that's probably where you want to slide your stop up under to, because the stock's going to have a high probability of breaking down there. So imagine if you had bought this stock down at 40 and you held it for a run up all the way to like 70, but then because you're a long-term investor, right, you watch it run all the way back down past your entry point. That's not a good way to do the markets. Okay, even if you're a long-term buy and holder, you still want to pull some profits at some point or you never make money. So this is a way that you could turn around and use the breakdown levels as an area to protect your investments. That make sense? You can see how accurate it was. Basically, like I said, we started to break down, and then eventually price took a major winger. If you're an investor, I'm sure you'd rather be knocked out here with a profit versus watching all of it evaporate, right? People do that kind of stuff. The doozy was a contact that I had that made millions on one stock. He was a rich guy. Made millions on one stock play, watched it all evaporate, and then lost $1 million on the same trade. How's that for, I'll say it, dumb. Okay. Oh, and I was on the telephone with him too, telling him, hey, you got to sell that here. Didn't listen to me. His financial advisor recommended against trading and selling. Okay. Ideal trading focused list is between 20 and 30 stocks. All right, let's talk about this a little bit because this is another point of confusion for folks. The pivot trader can handle 800 symbols and you can put them in all kinds of watch lists. But here's the thing, if you run 800 symbols every night, you're going to get lots and lots of setups. And one of the complaints I get is, hey, I'm getting too many trade setups. How many symbols you got in there? Oh, 800. All right. Are you gonna trade 800 stocks? No. So there's nothing wrong with putting 800 symbols in, and here's how I recommend you do it. Load one of your watch lists up. Maybe watch list number 1 is the big bucket where you just dump everything in, right? That's your watch list where you just put everything in there. And maybe once a weekend you run all 800. Then there's ways to sort things out and eliminate and move things around, right? You've got the average range. You might want to sort out all the stocks that really don't have a big range because you're not going to get a lot of movement out of those. You might want to stock out all. You might, if you're going to trade to the long side, you might want to just eliminate all the stocks in a downtrend. Okay, let's zoom in here a little bit. You can kind of see what I'm talking about. You can sort, and then you can tag and you can delete, or you can tag and move to a different watch list. You might want to eliminate low volume stocks. You might have a threshold that you only trade stocks that are above 400,000 shares a day or something, right? So there's lots of ways to reduce your list down, and what you really want to do is you want to get your ideal trading focus list down to something very meaningful and workable, and that's what you run every day, 20, 30 stocks. Okay, now there's some people that, you know, maybe they're nerds and they just love running this thing because it's like a slot machine. You know, they pull the handle and they watch the lights spin around and stuff, and they like it and they enjoy looking at all the stocks. That's fine, but you know, don't complain that it's giving you too many signals, because that's the job of the software is to run the analysis and to alert you to a potential setup, and that is your trading idea to work with further. That's all the software does. So if you can reduce your list down to the 20 or 30 that you really think are going to be good trading vehicles, it helps you save time. It helps you stay focused. The other thing about a focus list on stocks, so let's just talk about this a little bit, because again, this is where people get messed up a little bit. I recommend against finding a stock, you know, at night that you've never seen before that has a potential setup for tomorrow and then you jump it in. I recommend against that. I recommend that you narrow your list down to, you know, a good 20 or 30 or maybe even less, and you get to know those companies. Research a little bit about the fundamentals, research the news, what's coming down the pike, watch how they trade. You might even want to get into some of the chat rooms on like Yahoo and just see what people say about it. You might learn something that you're not seeing in the news or whatever. I would shy away from taking tips off of people on these chat rooms, because you'll get all kinds of people that will just jump in and say, oh yeah, perfect price to buy, right here, buy. You know, if you don't buy it right now, you're an idiot. You get people like that all the time. You don't want to listen to that kind of stuff. But, you know, you can get in and do a little research, see what people talk about. Sometimes people will post links and you can go and read more about the company. So the more you learn about the stocks you're going to trade, the more confident you're going to be when you pull the trigger. And that's why, you know, you can put 800 symbols in your system and run that on the weekend and try to like narrow the list down and stuff, but really try to get a focused list that's no more than 20 or 30. And hey, if you work it down to 10, there's nothing wrong with that. That you don't need lots of stocks to trade to make money. Okay? You want stocks that are good trading vehicles that are going to end up working. All right, let's talk about some other concepts. Okay, we're just going to kind of cover all bases today. Trading is kind of like a sport, and I just like to re-emphasize this, because people have the misapprehension. No, that's the wrong word. They have the wrong notion that they can find the Holy Grail, that they can find the perfect system. And for instance, like if my system doesn't give perfect signals, well, they got to go look for something else. Or if somebody else's strategy doesn't, you know, work every time, they got to look for something else. That is, you're going to end up with, like I said at the beginning, the best trading library in the world, every indicator there is, but you'll never make money. You got to eventually, you know, stick with something, focus on it, and develop it and get through the learning curve and make it work. And understanding that trading is a little bit like a sport will help you. So think about this. Your best golf pro, right? Decades of experience playing golf. The finest golf clubs. Do they hit the perfect shot every time? No. Same thing with a surfer. You got perfect surfboard. They've been out their whole life out in the waves, right? Do they never fall off a wave? Does a baseball player never strike out? You know? Does a tennis player never hit the net? So trading is a lot like a sport. We do want to develop our skill level. We do want to use the best technology, but you have to understand that it involves a setup, and if we like the setup, we take a swing at it. We take a whack at it, just like a baseball player. They're going to be up waiting for a good pitch, and if they see one coming in, they're going to take a swing at it. All right, same thing with a surfer. They're going to be out waiting for a good wave, and if they think they see one, they try to jump on board. Trading is exactly like that. All right? So, we're just covering some like big concepts here now. We got 3 goals of swing trading. Write this down. This is a good one. We want more winners than losers. You've probably read in some books like, hey, you could lose more than you win but still make lots of money. Technically, that's true. You could lose 10 times in a row and then catch one stock that goes 350% and then you make money, right? That's possible, but that's like a needle in a haystack. So you're better off getting away from the notion that you can lose more than you win and still make money. You want more winners than losers. Okay, that just takes us right back to precision, accuracy. You know, I mean, does a baseball player want more base hits than strikeouts? Of course they do. We want bigger winners than losers on average. So that means in the end, when we average it all out, we would like to see maybe our losses average out to no more than 2.5%, 3%, 4%. But we'd like our winners to maybe average out to between 8 and 10%. You see the difference? It's not about the one trade. It's not about the one event. It's about how it all averages out over the series. And then absolutely, the unpardonable sin is the catastrophic loss. We do not want to ever allow a catastrophic loss. That could end your trading career. It could lose a lot of money. And you will be sick to your stomach. And it's an eyesore. Once you allow a stock to run away from you, that is an eyesore in your account, and it can only get worse, and it frustrates you. Every day when you open up your trading account and you see that one trade that's now thousands of dollars, got thousands of dollars of drawdown, it just makes your whole day depressing. So we never want to let catastrophic losses develop. Now let's talk a little bit about kind of a mental mindset. I don't get super big into psychology. I don't recommend you read 400-page, Tolstoy tomes like War and Peace about trading psychology. You don't need that. But we do need a basic mindset, and the mindset is this: when we trade over the series, we want to attempt to trade at or around the break-even level, or score big. Okay? I use the same mindset in day trading. So what that means is that you might take a trade, a small trade, a swing trade, and make a small amount of money. You might take your next trade and get stopped out. But you're still even, right? Now you might take another trade, make a little bit of money. Now you might take another trade, stopped out. So you're trading around break even. You don't want to get frustrated about that, which is what the common trader might do. They might go, oh man, this is frustrating. I'm not making any money. That's your prime directive. That's fine. That's like falling off a cruise ship and you're treading water. You know, you're still alive, right? However, if we can catch some trades while we're doing that, while we're treading water, if we can catch some trades that score big, that's where the money comes in, okay? So let's just take a look at a couple graphics here that kind of illustrate that. Here's a series of trades. Remember, the swing trading process is a process over a series of trades. We're not betting the farm on one trade, crossing our fingers, you know, hoping we win the lottery. We're in this for kind of like a business. We want to do this on an ongoing basis. So here's our break-even level. So here's our little, you know, winning trade. Then we might have a little stop out or a break-even knockout or whatever. And we have another little winning trade, another little stop out. So we're cruising along pretty much around, you know, we're not making money, we're not losing money, right? No catastrophic losses. If we can do that, by sheer dumb luck, if we're doing some basic, you know, good setups, we're going to catch a break. The market's going to give us some winners. And depending on how far we let them run, that's where we're going to score big, you see. So here's what that looks like. Here is our net profit then, you see. Now, if we took a catastrophic loss, like this equal distance in the other direction, now you see that we end up at a break even or with a loss, and so all of our trading is for naught. So the concept is attempt to tread water until the market throws us a bone, basically, and we can catch runners and trail stops. Now, if you do things correctly, you can achieve 7 out of 10 winners. Now, that doesn't mean that you've done 10 trades and 7 were winners and 3 were losers. I mean, that's possible. It might mean that you did 15 trades and you had 5 draws. You were knocked out break even. Those prevented a loss, which reduced the number of losers, right? So you did 10 trades. I'm sorry, you did 15 trades, and 5 of them, I should make a graphic that shows that, but you did 5 that you got knocked out break even, you got your stop to the break even level, or you did the delta neutral and then you still got knocked out. Didn't lose anything though. But that reduced the losers. That's how we can hit a statistic like this. The other thing here, you can see it graphically. The losers, we keep the losers small, but we let some of the winners become big. Okay? So if you have a trade that's working, you want to be generous to that trade. Let it go. Let it work. If you have a trade that's not working, you want to be stingy. You want to get out of that sucker. The quicker that you can recognize that a trade's not going to work, get back to cash, and avoid a loss, the better you increase your overall odds, you know, over the series. All of the stuff I've been talking about today, other than the specific setups, works for day trading as well. Okay, now the other thing too is your monthly gains are going to vary. And I put this chart up because when I come across new folks in the market, one of the things that I hear that a lot of people, they want to make a fixed amount per month. You know, they have the wrong notion that they can trade for a living and they're going to make, you know, X number of $1,000 a month and they can live off of that. It doesn't work that way. You know, if you had a boatload of money in a huge account and you did make, let's say you made a ton of money, you could maybe pull off a small percentage per month that's the same amount every month, right? Let's say over a 3-month period you made 10 grand and then each month you want to pull 1,500 out. That's reasonable, but to make the same amount of money every month, it's not going to happen. Your gains and losses are going to go through big cycles just like the market does. So for instance, here's a good example. This chart is upside down basically. So January's down here, February. This is some chart I pulled off of a thing from, gosh, a long time ago. But what it shows you is in February, when I took profits on trades I was in, I netted 950 bucks, let's say, okay? And then the following month, the trades I took off the table and closed out, I netted 1,300 bucks. In April, the trades that I took off the table had a loss of 280 bucks. Okay, when everything was said and done, all the trades that got closed out, that's how it penciled out. And then you can see here in June was where I either had some really good runs or I closed out lots of trades, and that was where the bulk came from. But when I average it out, that would be my monthly average. Okay? That is the reality of trading. Don't get frustrated if you can't make the same amount of money every month. It just doesn't work that way. Okay? Okay. Most of you folks know me. Some of you folks have been following me for years. I'm Jeffrey. I got myself a cool little trading lab I set up in my house now, and I continue to do research. I continue to support this software, and we are going to have another version come out within probably about 2 more months, 3 more months. Every time I do an upgrade, it's a little bit like childbirth, even though I have never experienced that, but I'm just guessing, because a lot of people have to upgrade and whatnot. And so the next version will probably hit in the next few months, and I am shooting on, that'll probably be the last major upgrade. There may be little small upgrades with fixes and things, but I've got a few more things planned that are pretty cool. We don't want to put too much in the software and make it, you know, a hassle to use. But there are a couple more things that I know I can get in there that I'm working on that'll be kind of neat for the next version. There'll be a brand new screen in the trade management also. We haven't even broached that subject today. As a matter of fact, let me load up the software and we can take a look at a couple things. Now, I am going to go ahead and get into Q&A here a little bit. I know I talked everybody's ear off today, but we did cover a lot of ground. The latest version has a market meter as well. The market meter, here's the thing. You're not really going to trade off the market meter. Like, you know, you don't hit a certain thing and go, oh, I got to buy. This is going to give you a general idea what the market's doing. The market is selling off, and it's reaching, it's getting close to oversold, but it's going to take a lot more selling to get all the way to the end here. Just one thing you might want to know about the market meter, this is not like a stochastic or anything like that, because stochastics are great when it comes to you know, if your stock or the market's trading in a sideways channel, the stochastic can kind of pick the bottom of the channel and then the top. But once something gets into a super strong trend, a stochastic or a MACD, stuff like that, it's almost useless. You could have something 100% overbought, but the stock just keeps going up for 2 more months, right? So you can't trade off of these. This meter is my own design of trying to analyze what the market's up to, and it's really just a general. You want to use it as a general, like a thermometer. Okay, so we know that the market's selling off and kind of getting oversold, and we're probably going to see it run back towards the center. And you know, if we run up towards here, you can be assured that the market's like up in overbought territory. So just keep that in mind. That you know, there's nothing magical about this, but this is going to be better than your typical stochastic, because it also will work in, you know, a trending market. If the market trends higher, you're still going to get good oversold, overbought areas. That's one of the new features in the 3.2 version. If you remember correctly, I was talking about that 3-day rule, right? Well, there's your running short-term range. It's kind of a little bit better than the 3-day rule that I showed you. It's got a little bit more advanced stuff to it. So you can use this range also to plot on your charts. I would put this on your stock charts that you're watching for a trade. Just put like a thin dotted line at the top of the range and the bottom of the range as a reference point. You might be, you can take a trade below it if you want, or you can wait for the trade setup to kind of line up with the top of the range. Okay, if the more you can correlate the better. Now, the only other thing I'm going to mention real quick, and I'm going to get to the questions, is this. There is and I cover this in the help, by the way, in the tutorial. There's a resistance column here, okay? There is the price. This is the current close. Now, this is not, I don't think I've updated this. Maybe I did. But the price, and then you'll have a resistance area. So notice in this example here, 5211, the software is detecting resistance. What this really is this is what's called the overhead supply line. And that has to do with the balance of the buying and the selling balance on the short term. This is very short term too. We're talking like just the swing trading cycle. All right, 5 to 8 days. So the software is detecting that. Here's the current price. Here is the overhead supply line. Okay, I didn't have enough room to put overhead supply line, so I put resistance at 53.78. You can put a horizontal line on your charts there as well as a reference point. Okay. Again, we're not trying to confuse you, but all these things are meaningful. So there's your overhead resistance. Down at the bottom, you've got your top of the 3 or 4 day range. Okay. And then you might have a signal that gets triggered or an alert that gets triggered. You can utilize all that as reference points. Now, one of the questions I get all the time is, well, what if, let me find an example. Oh, here we go. This would be a good example. Here is Amgen, okay? The current price is, oh wait, that's not a good example. I thought I saw one. Hang on. Okay, here we go. It was a little bit lower. All right, yeah, here it is right here. ATVI. Current price is 2090, but the resistance is 1990. Well, how can that be? Well, because that was the resistance and the price just crossed above it. Okay, that was the last overhead supply line detected. So don't get confused about that and scratch your head and think that the program's broken. If the price is greater than the resistance, that means that the price has finally crossed that overhead supply line. Now, I have it designed so that like 1 or 2 days, you're going to actually see it'll turn green. And that's alerting you to the fact that we got the crossover. You can see here that the overhead supply line, the resistance line was 41.62. Now the price is 42. So it just recently crossed like as of a day or two ago. Okay? So get in the habit of plotting these resistance lines on your chart, running a short-term range on your chart, and then also your macro breakout levels, if there is one, and then any kind of setups that you get. Plot them as lines on your chart. Those are reference points to watch. Now, the only thing I didn't really talk about, and I don't have a chart for it to show you, but actually, or do I? No, there's going to be a lesson in the Online Learning Center webpage that everybody should have, and there's a thing about the macro line setups. Here's what I want you to understand about the macro line setups, and that's the last thing I'm going to talk about, and I'm going to get to the questions for you. You're going to notice that we've got like a convergence breakout, we got shallow pullbacks. They give you price to watch and the stop loss and the targets and all that. And the macro line setups, They don't. They just give you a price to watch the long. They don't give you a stop. The reason why, they're not an imminent trade setup. I mean, it could be, but it's a macro line. You want to put it on your chart as a reference point. What that means is, and this is a little bit different from the macro breakout and breakdown levels. It's a little bit different, but it's kind of the same thing. It could portend a big move. It's just a different formula that I came up with. And the difference is that a lot of times when you get the macro breakout, you're not going to cross it for 3 weeks. The macro line setup, typically you're right there right now. That's the difference. And so you want to plot a line, horizontal line on your chart, and you want to be watching that level. You could get a blast off. All right. Now, a savvy trader doesn't always have to follow every single setup in the software. Remember, the setups in the software are trading ideas to work with. You may have your own trading ideas that you work with. That's fine, and you can piggyback on these macro line setups, basically. Okay, I lied. One more quickie thing, and then I promise I'm going to get to your questions. Let me see if I can find a... Okay. Let's say that you are a position trader, or let's say you want to be like a dollar cost averager or something like that. Notice that you have a macro breakout level detected above, okay? Now, I'm going to give you one scenario because everybody trades a little bit different. Some people are doing swing trades. Some people want to buy a stock and hang on for a couple of weeks or a few months. Others want to build a position in something that they think could like run up or recover. So I'll give you a perfect example. Oil. In fact, I should put oil in here. Oil has been selling off like mad. So people are starting to salivate like Pavlov's dogs right now, wanting to get in and try to catch the bottom of oil, right? Oil will in the future make a massive, drastic, miraculous recovery. It will. It's going to bounce like the mother of all bounces. However, I don't think it's going to happen like anytime soon. We can put in fact, I'll do it. Let's just see if we get something right now, because I want to illustrate this point. All right, bear with me. I'm going to run analysis on USO real quick here. Okay, it looks like we're not generating a macro breakout level yet. So there's a little bit of pause for you folks that are wanting to dive into oil right now. We're not even getting a breakout level detected yet. But what I was going to say is when we do, the software is going to go ahead and give you that breakout level, and that'll be the price to beat. And so we've got little short-term ranges here you can work with if you want to be a trader. USO is the ETF for one of the ETFs for oil. Okay, and so one thing that you can do if you're more of a investor or a financial manager type of a person, and you want to begin a dollar cost averaging plan, which is a totally viable way to do the market. Okay. The thing with dollar cost averaging is you want to wait for at least a macro trigger that gets you started. All right, and that would help your dollar cost averaging plan out. So let's say that every month you're going to buy $500 of a stock until you accumulate 10 grand worth, right? And you can use the software to find the entry points. But because your dollar cost averaging may be over 20 entries, you're not going to, in that instance, you wouldn't really use the recommended stop. You'd want to use like a big wide stop, maybe, 8% on your average share price type of thing. But the point I'm trying to make is that even if you are going to utilize an approach like that, dollar cost averaging, that macro line or the macro line setup can help you quite a bit. Okay, I am going to get to the questions right now. And I'm going to guess that there is a boatload of them. Oh yeah, there is. Now, if you came in late, I am recording this, and I will edit it down and get that out by next week. So let's jazz through the questions here. Do you use this for recovery stock watch list? You can. I was just talking about that. Yeah, you can put. You can pick one of your watch lists and make that your recovery watch list, and you can use the macro breakout or a macro line breakout as your starting point. Question: what volume indicator do you use to determine the macro breakdown levels? Yeah, I'm not using anything off the shelf. It's kind of like my own formula, but it's not just volume. I'm looking at volume zones as well as patterns in the stock, and there's some hybrid like moving averages that I created that are all in the mix there. Sometimes I even surprise myself how I stumble on these formulas, but I've been looking at this stuff so long that I think half of the stuff I figure out is just my subconscious that figures it all out. In your trade manager, you show the stop for your trade when you first put it in. The next day after you run a trade analysis, the stock moves up. Oh, you know what? I didn't really talk about how to trail a stop. Let's talk about that. Now the software, I'm not going to get into the trade manager today because that's a whole different system, really, connected by a button to the software. So you actually, it's like when you go to a bar and it's 2 for 1, you get 2 beers for the price of 1. You're actually getting 2 systems in the software for the price of 1. And the let's just, so that people know what we're talking about, that's this here, the trade manager. This is its own complete system. And in our next version, we're going to have a new screen on this system that actually runs the performance for you and tells you how good you're doing on the overall trades. So that's coming soon. Yeah, in this section here, and again, I don't want to get off on this. This is another complete lesson in and of itself. You've got some targets. You've got some volatility stops, and the only thing I'll mention is this. You might say, well, look, I'm getting the targets on the main screen, and I'm getting some stops on the main screen, so why do you have them here, or why would these be different from what I see in the main screen? Because this is going to take into consideration if you're putting your own trade in that you're doing, right? You didn't get it from my software. So the analyzer is going to do its best to wherever you got into a stock, it could be based off of your trade entry. It's going to try to give you like some targets and some volatility stops, and you got a wide trailing stop and a swing trading stop. It's going to do that for you because you might want to stick your own trade in there, right? It has nothing to do with one of my setups. The other thing too, as you go, a lot of times this stuff will be based off your average share price. This manager lets you take up to 3 entries and average them out. This is not a dollar cost averaging system, so you can't do like 30 entries, but in swing trades, more often than not, you're not going to take more than 2 or 3 entries on a swing trade. Most of the time you would do 1 entry and maybe 2 exits, so it allows you to do that. But anyway, let's get back to what the question was, which is, and I'll see what I did with my. Okay, here we go. Let's talk about trailing stops a little bit. I'll throw you guys another bone here. I'll give you a little technique that you can follow. Again, it's good to know this stuff, even if the software would compute something for you. It's good to know this stuff just so you can kind of, fine-tune your trading and also understand what the heck's going on. I'll give you a technique, okay? I don't have a graphic for it, but jot it down on a piece of paper and you'll picture it in your mind's eye. I showed you the little trick move to get to know when to go to break even, right? So if you get into a trade, now this is whether you do the delta neutral stop move or not. Some people don't want to do that. Some people will buy 200 shares and they just want to hold 200 shares. That's perfectly fine. You're going to have like the same kinds of odds. You're going to have wins, losses, and draws. Let's say that you bought 200 shares here and the trade instantly went against you and you got stopped out. Okay, you got a loss. Let's say that you bought 200 shares, the trade runs in your favor, now you got a winner. Let's say that you buy 200 shares, you're not going to sell anything. The trade goes in your favor and you move to break even. Remember, when the 5-period moving average crosses back up through your entry line, that's the day to move your stop to your entry point, right? Now that could potentially come down, knock you out, now you have a draw. The good news is literally 8, 9 times out of 10, once you hit here, those trades tend to take off. I mean, you're gonna see that this is a really great little trigger to get to break even, and in other words, you won't get stopped out at break even. You'll get some kind of a move out of that. So the question is, well, how do you trail your stop? Well, one thing, there's a couple methods you could use. I'm going to give you 2 freebies here to play with on your charts. One of them involves the 5-period. Okay. As your stock moves in your favor, you could just move your stop to where the 5-period is 1 day back. Make sense? So your first goal is just get to break even. Once you're at break even, then you start trailing. So the day you went to break even, it might take 2 more days. So let's say this day here, and then you would, actually I said 2 days back, I meant 1 day back. Then you would just go 1 day back. So you got, basically it's 2 bars. 1 day back, and then your stop loss would go at the 5-period. The next day over here, you would slide it up to that part. That makes sense? Trailing stop losses, again, one of those things that gets jiggy, because if you trail too close, you can get knocked out of a good runner and miss like a huge move. Or if you trail too far away, the trade can make a big move, but you give too much back at the end. So there's actually some acceleration features that go on. We want to trail behind at a certain distance to stay in, but once things get hot, we want to start accelerating. And I'll give you 2 ways that you can do that as well. Okay? Here they are. Write this down. I don't have a graphic for it. Any day that gaps up, all right, from the previous day, put your stop below the low of the previous day. Or any day that gives you a super long range day, you can put the stop directly below that day. Okay, 2 little extra tricks. Nothing's perfect, but you'll see those 2 little tricks will tend to keep you in. Actually, I give you 3 tricks. You trail 1 day back on the 5-day. Anytime you get a gap up, go right below the day before. And anytime you get a long-range day, then put your stop right below that low of the long-range day. One final tip. Let's say that you're hitting your profit targets. Let's say that you were targeting like 10% on a trade, and over the course of like 8 days, the stock runs up and it's getting close to that 10%. Maybe you're actually a little bit over, right there. And in one day, you have a super long range day that blasts right through your 10%. Okay. Now you can take your stop because you've already hit. I mean, you don't have an order in, but that was your target zone, right? Now the price is above your 10% target, right? And you want to protect. You want to start really accelerating that stop. So on a long range day, you basically just take the midpoint of that long range day and put your stop right there, and that would be above your 10% goal. So you're actually protecting that, maybe, and a little extra. And hey, if the stock keeps going, you just go back to the other trailing stop. Maybe you trail 3 days back, that type of thing. Or I'm sorry, 2 days back on the 5 period. Make sense? So the goal is to figure out when things get really super hot and accelerate the stop behind so you don't give too much back. All right, I swear, I promise I'm going to burn through the questions here. So if you got to go, you got to go. This will be recorded and I'll get the link out, but let me get into these questions here for folks now. Again, today was like a super mega intense training, so I don't have a problem hanging around here for a couple hours. Doug from Milwaukee, Wisconsin asks, the 3/4 retrace on the super deep pullback looks like a Fibonacci. How do we use the Fibonacci with this? Well, yeah, if you're like really, really, really into Fibonacci's, that's great. But the 3/4 retrace is actually, that's all it is. It's just a three-quarter retrace. You don't really even have to get into all the Fibonacci stuff. And you basically just take, your entry to, or the lowest low back to where this, in that particular example with the super deep pullback. And I think I spell this out in the documentation too. And you just figure out like a 3/4 retrace, or you can figure out 25% or 75% would be easier. Take the highest point, subtract the lowest point, and divide it by 4, and then subtract, 1/4 of that.